Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Today, we've got three major stories for you. First, a potential US-Russia Arctic energy deal that has President Trump and Vladimir Putin talking, which has sent German defense firm Rheinmetall soaring 1,500%. Then we'll cover how Chicago Fed President Austan Goolsbee is expressing a new note of unease on rate cuts after a shocking inflation report, putting the Fed's September meeting under a microscope. And finally, Wall Street is all in on the taco trade, but a Piper Sandler analyst warns President Trump's deals are built on phony promises with a Supreme Court ruling looming. The most unexpected news in the finance world today has to be a potential US-Russia energy alliance to exploit the Arctic, which is sending shockwaves from Wall Street to Kyiv. The prize is a geological jackpot, an estimated 15% of the world's undiscovered oil, and a staggering 30% of its undiscovered natural gas. But actually, tapping into this so-called jackpot is a monumental challenge. The Arctic is one of the harshest environments on Earth. We're talking about extreme cold, shifting sea ice, and total remoteness, all of which requires incredibly specialized and expensive technology. You know, while both US and Russian firms have developed platforms designed to withstand these conditions, major questions remain. The World Wildlife Fund has emphasized that the effectiveness of cleaning up a major oil spill in icy waters is almost non-existent. A spill could devastate fragile marine ecosystems and the indigenous communities who depend on them for survival, with recovery taking decades. This isn't just about energy, it's a major geopolitical pivot. Following a summit in Alaska, the US is now pushing for a rapid peace deal that Ukraine is being pressured to accept. As Berenberg's chief economist bluntly stated, Russian President Vladimir Putin got US President Donald Trump interested in business deals. The direct result, the US may be preparing to end its support for Ukraine, and the markets are reacting with lightning speed. The same analyst warns Europe will have to spend a lot more for its own defense. That warning has turned into a gold rush for investors. Shares in German defense giant Rheinmetall have skyrocketed an incredible 1,500%. Italy's Leonardo is up over 600%, a supercharged rally built on the expectation of a new European arms race. The challenge here is enormous. This isn't just about buying more tanks and planes. Europe is scrambling to fill massive technology gaps in areas like AI, cyber warfare, and drones because for decades it has relied heavily on the United States. To put that in perspective, European armed forces currently operate 29 different types of destroyers and 20 different types of fighter jets, while the US operates just 4 and 6. Respectively. This lack of standardization makes it incredibly difficult for them to fight together effectively, which is why this new spending is so urgent and so massive. However, if you zoom out, you'll see another layer to this. While defense contractors celebrate, Bank of America is sounding the alarm for a deep energy bear market. They warn that a flood of new Arctic oil and gas could crater global prices. Brent crude is still trading near $66 a barrel, a price that strategists say has not yet factored in this seismic shift. So the thing is, a flood of cheap oil and gas has a huge hidden cost. It directly threatens the global transition to renewable energy. When fossil fuels are cheap, it makes it much harder for cleaner alternatives like solar, wind, and especially green hydrogen to compete economically. Energy giants might be tempted to delay their green investments to chase short-term fossil fuel profits. So while consumers might see lower prices at the pump, the long-term price could be a major setback for climate goals. Meanwhile, Ukraine's own government bonds, a key indicator of the nation's health, are stalled at a distressed 55 cents on the dollar. The board is set for a monumental realignment of global power and capital. The question is, as these new alliances are forged in ice, who will be left out in the cold? All market data is subject to change. This is not investment advice. Speaking of market-moving surprises, just as Wall Street was pricing in a near-certain interest rate cut, a key Federal Reserve official just threw a wrench in the works. Chicago Fed President Austan Goolsbee, a voting member on the committee that sets rates, says he now has a note of unease about the economy, casting serious doubt on what he once called the golden path to lower rates. Interestingly enough, when a Fed official like Goolsbee speaks, he's not just talking to us. He has to choose his words with surgical precision since high-frequency trading algorithms are parsing every syllable in real time. Research shows that even qualitative descriptions in these statements can move markets as much as hard numbers. So officials have to craft their language to be clear for both humans and machines, avoiding any ambiguity that could trigger unintended market volatility. What's causing the sudden hesitation? A surprise inflation report. The Producer Price Index, which measures wholesale costs, just posted its largest monthly gain in about 3 years, a jaw-dropping number that caught many off guard. The PPI is a key leading indicator. It measures the prices that businesses pay for goods and services. If their costs go up, it's a strong signal that those higher costs will soon be passed on to consumers, leading to higher consumer inflation down the road. Goolsbee is pointing directly to rising services prices, warning they are not obviously going to be transitory and are in fact kicking up. This is where the situation takes a more complex turn. Another storm cloud is gathering that could derail the Fed's plans, tariffs. In a stark warning, Goolsbee stated he thinks of tariffs as having a heavy stagflationary component. That's the toxic economic mix of slow growth and high inflation that policymakers dread. Now, we're seeing Goolsbee express concern over tariffs, while at the same time, major companies are deploying some incredible technology to fight those very costs. We're talking about AI-powered logistics that can predict tariff impacts and reroute shipments in real time. Some are even creating digital twins, exact virtual replicas of their entire supply chain to simulate disruptions and find the most efficient, cost-effective path forward. This tech is designed to absorb the shock of tariffs, potentially making the economy more resilient than in the past. Because of this, he now says the Fed needs at least one more convincing inflation report to figure out if that golden path even exists anymore. When a Fed official says they need more data, it's not just the official government reports anymore. Believe it or not, the Fed is now using a tech stack the public rarely sees. They're analyzing high-frequency alternative data, things like credit card transactions, web scrape prices, and even satellite imagery of shipping ports and feeding it all into sophisticated machine learning models. This gives them a much faster, more granular view of the economy, helping them nowcast where things are headed long before the official numbers come out. This puts the Federal Reserve September meeting under an intense microscope. While markets are still betting on a rate cut in September, the odds for more cuts later this year are already falling. When you see news reports citing the odds of a rate cut, that number usually comes from a tool called the CME FedWatch. It works by analysing the prices of financial contracts called 30-day Fed funds futures. The price of these contracts is essentially 100 minus the market's expected average interest rate for that month. By comparing that implied rate to the Fed's current target, the tool's algorithm can calculate the probability of a rate hike or cut. It's a direct window into what the big money on Wall Street is thinking. This all begs the question, is the market on a collision course with the Fed's newfound caution, and is that so-called golden path about to lead right off a cliff? As a reminder, all financial markets are subject to volatility, and this report does not constitute investment advice. While the Fed is getting nervous about tariffs, Wall Street is betting big on a new acronym that says they'll never happen, TACO, for Trump always chickens out on trade tariffs. Investors have pushed the market to all-time highs, convinced the worst is over, but a handful of top analysts are sounding the alarm, warning that the consensus is dead wrong. From a psychological perspective, this TACO trade is a classic example of what behavioral economists call normalcy bias. It's the human tendency to believe that because things have followed a certain pattern in the past, they will continue to do so in the future. Investors got used to a cycle of threats followed by walkbacks, and now they're betting the farm that the pattern will hold, potentially underestimating the risk that this time could be different. According to Piper Sandler's head of US policy, trade stability is not in the cards. He claims the trade deals being announced are built in part on phony promises that could easily fall apart. Foreign officials from Japan and South Korea are already publicly disagreeing with President Donald Trump on the terms, signaling the deals are anything but settled. This kind of strategic ambiguity has a real economic cost. When businesses don't know what the rules will be from one month to the next, they stop investing and hiring. The Organization for Economic Cooperation and Development has already cited this uncertainty in downgrading US GDP growth projections, and the UN has warned of a global slowdown driven by these very trade tensions. It creates a deep chill on the economy, but that's not the whole picture. The real turning point is that the president's entire tariff strategy faces a massive legal challenge, with the Supreme Court likely to rule on his authority within the next 10 months. The crux of the issue is that the president has been using a law called the International Emergency Economic Powers Act, or IEEE, to impose these broad tariffs. Now, get this, IEEPA was designed for targeted sanctions, like freezing assets during a national emergency. It was never intended for sweeping tariffs on all imports, and lower courts have already expressed serious skepticism about whether this is a legal use of that power. One analyst puts it bluntly, if the courts find he overstepped, then the deals are null and void. However, another expert from Raymond James warns that even if the courts block him, the president could pivot to a different authority, the Tariff Act of 1930, which allows for tariffs of up to 50%. His stark conclusion, tariffs are here to stay. He's specifically talking about a rarely used part of that law, Section 338. It gives the president the power to impose tariffs of up to 50% on countries that he determines are discriminating against US goods. It's a powerful tool that could be used to continue the trade war just under a different legal justification. This all happens as Wall Street seems to be looking the other way. Prediction markets have slashed recession risk from 70% down to just 10%. A move one analyst suggests means the broader tariff risk is now completely priced out of the market. It begs the question, is Wall Street seeing clearly or walking into a trap? And that's a known blind spot for traditional financial models. They are built on historical data and assumptions of rational behavior, so they struggle to quantify the risk of an unpredictable, personality-driven policymaker. This means these markets can be blindsided by actions that don't fit the established pattern. Perhaps the biggest unknown remains what one strategist calls the Trump factor. He warns there's nothing to prevent him from changing his mind again down the road.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.